Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us with this podcast?
Two things we would love it if you would do.
Do
it right now.
In a row.
If you're not driving, please don't do it while you're driving. First of all, we would love it if you would subscribe. If you're not subscribed, so you get every episode on Thursdays when it comes out. So we would love it if you could do that. We would also love it if you would visit our website and sign up for our weekly newsletter where we send out a link to the episode, but also some little show notes, little summary. Yeah, it's great. Mm-hmm. So we'd love it if you would do that as well. Today, Josh,
yes,
the question that a lot of people are asking right now, because there's people talking.
Yes.
People talking.
Mm-hmm.
People are asking, are we,
yes,
as a United States economy,
yes,
in a recession?
Ooh, yeah, good question. Should be easy. I'm sure there's some sort of like set standard for this, so we can tell them exactly yes or no to this answer.
We're going to get to that.
All right.
Yeah, we're going to get to that. So, yes, a lot of speculation whether the U.S. is or is not officially in a recession. So, as a reminder of how we got to be where we are right now, on July 28th,
Yep, good day. Yep.
the second quarter gross domestic product for the economy came out. Mm-hmm. It was negative 0.9% annualized. Second quarter in a row of negative GDP reading. First quarter was negative 1.6.
Yep.
By
so
traditional.
For 2 quarters.
Yes. By traditional thoughts, 2 negative consecutive quarters of GDP would be indicative of some sort of recession.
That's what they call a rule of thumb.
It's a rule of thumb. However, the NBER, or the National Bureau of Economic Research, Research, they have yet to confirm that we're in a recession. Couple reasons being that unemployment is...
Their Zoom was muted.
Yeah.
You can't get it. I don't know.
They can't get it out. Unemployment is really low. In fact, the last reading we got, which was looking back at July, came in below pre-pandemic levels.
Yes.
And that now we're back to levels not seen since the 1960s.
Yes. Like 56 years
3.46%.
53 years ago, something like that.
3.46%, technically rounds to 3.5, but 3.46% unemployment, with July adding over 500,000 jobs to the economy. There were over 10 million jobs openings still in the economy as well. So a lot of the labor side of things looking very strong. That is one of the reasons there's some hesitation to say that we are in a recession right now. So I was reading, Josh, because that's what I do sometimes.
You like to read?
I was reading a CNBC article, which we'll link in the show notes, that outlined a few points in this discussion from experts in the field. Because as much as we would like to say we're experts in the field, we're not economists.
Yes, unless I'm in corn. That's when I become outstanding.
Outstanding in your field. Yes. So both President Joe Biden and Federal Reserve Chair Jerome Powell have both said we're not yet in a recession. Again, they pointed to the strong labor market. They pointed to rising wages. Again, the reminder is that we're waiting for the official declaration from the National Bureau of Economic Research.
Yes.
They have yet to call us in a recession.
They actually call everybody, which probably is why it takes a while. You're farther down. You're in the W, so you're still waiting for the call.
It's going to be like 2030 before I get that call.
Yes.
But regardless of the country's economic standing, consumers, they're not feeling so great.
Yes.
They're struggling in the face of sky-high prices. Inflation's been hot for a while, and nearly half of Americans actually say they're falling deeper into debt. So debt is going up. That's not necessarily great. So a guy named Thomas Phillipson, or Tomas. There's no H, so it could be Tomas.
Yes, that's probably it.
He is a professor of public policy studies at the University of Chicago and former acting chair of the White House Council of Economic Advisors. That's a lot of titles.
So do people sit on him like he's an acting
chair?
He pretends to be a chair in this board?
Exactly.
Okay.
He said that what really matters is that paychecks aren't reaching as far. What you call it, whether that be a recession or not, is less relevant.
Yeah.
And that is true. Paychecks are going less far. The last
we know
inflation reading
real earnings is down.
It was 9.1%. We're seeing wages rising at about 5%, which is historically pretty good, but much less than inflation. So you're in negative real wages, down about 4%. That's That's called bad news, right?
That's called painful.
Makes people feel unhappy about their financial situation. So, amid fears of a recession and rising interest rates, most people said they're already seeing their standard of living declining, according to other reports. So, that means, your dollar's not going as far.
Yes.
So, maybe you're having to cut back on certain things, you're having to go generic on certain things, make substitutions, not do this, not do that.
Side note.
Yes.
What is one thing you will not go generic on at the grocery store?
Toilet paper.
Toilet paper?
You?
Well, since you already said that, I'm going to go, because that is one.
Yeah,
I would
yeah.
definitely say. Second one is laundry detergent.
Really?
Mm-hmm.
Huh. You notice a difference?
Yes.
We go generic on laundry detergent, not on dishwasher detergent.
Ah, yes, that's the other good one.
Cascade.
We've tried different of those little
Pod
and
things.
They don't work as well.
Really?
I
That's all
think
we
the
use.
difference is the amount that I use of non-brand detergent.
Okay. Gotcha. Yeah, we use a
through
Cascade
it.
Platinum pods,
Mhm.
and we try and run it once a day.
Mhm.
And they are more expensive for sure. I feel
They
like they
good
do a pretty good job. But yeah, there are other a couple things. I guess I do not. You go generic on coffee.
Mhm.
I don't go
gotta get
Kroger brand or whatever. I get Folgers,
Folgers.
which is still like most people, bougie people are like,
Yeah.
ew. Like that'd be a step down for them. I think that's
You don't do the instant coffee?
Nope, can't do it. I don't go generic on
Cheese. So Kraft
Kroger brand cheese?
squares. I don't feel
Kroger
like they
brand.
melt as well. I've had them, like burgers and stuff. They just don't melt as well.
Oh, the off brand?
Yeah.
Really?
Mhm.
Huh.
There's a difference. You should put one, like get a slice of each and put it on when you're grilling one time and just look at the difference. There is a difference.
This is
there.
a total side note that we stopped buying pre-shredded cheese.
Okay.
Some people have health issues with it. Like they're just like, oh, it's not healthy because XYZ. But we have found that it just melts better and it tastes better when you shred it yourself. So we buy blocks of cheese and we have a cheese grater and we shred our own cheese.
A lot of work.
It really is.
Man.
I know.
Would make
And
me
we
use
go
less
through-
cheese, that's
no,
for sure.
we go through cheese.
Oh, man.
My daughter eats cheese quesadillas.
Oh, we go through cheese like crazy. That's why I'm thinking that would just be, I would have like the strongest arm. You'd be like, Josh, why are you so lopsided? I'm grating cheese all day.
Grating cheese all the time. So, as a reminder, officially the NBER defines a recession as, and I quote, a significant decline in economic activity that is spread across the economy and lasts more than a few months, end quote.
Very specific. I mean, that is down
That
to
is down
a
to the
T.
penny,
Yes.
right? So, in fact, the latest quarterly gross domestic product report, which tracks overall health of the economy, showed a second negative contraction this year. Yes, exactly.
Yes.
We just talked about that. So, the most vague definition of a recession,
A
I think you could
significant
probably
decline
over more than a few months.
in economic activity that is spread across the economy and lasts more than a few months. Yeah. Man,
There's-
not a single
they're
thing in
not-
there is defined.
Yeah, they're not trying to
Besides-
lock down anything
Yes.
on
Oh, man.
this. So still, if the NBER ultimately declares a recession, it still could be months from now before they do that. And it will factor in other considerations as well, such as employment and personal income, which are both of the kind of more bright sides of the economy.
Income not as much as employment.
Exactly. So for now, consumers should be focusing on high energy prices and overall inflation. Phillipson talked about, one of the guys in this article. And to that end, the Fed is making aggressive moves to temper surging inflation, but it will take a while to work its way through. Another lady, Diana, I'm not even going to say this right, but I'm going to try because that's what I do. Ferkert Roth.
Very probably right.
Probably pretty close.
Yeah.
I'm only going to say that once.
Yeah.
An economics professor at George Washington University and former chief economist at the Labor Department said Powell is raising the federal funds rate and he's leaving himself open to raise it again in September. He's saying all the right things and that consumers are paying more for gas and food, so they have to cut back on other spending. Negative news continues to mount up, and she says that we are definitely in a recession.
No, she's not the NBER.
She's not the NBER.
So she could say whatever she wants.
It doesn't mean anything.
Man.
So the direction of the labor market is really going to be key in determining the future state of the economy. Both people we just talked about said decreases in consumption come first. Phillipson noted, if businesses can't sell as much as they used to because consumers aren't buying as much, then they lay off workers.
Yeah.
We've definitely not gotten to that point yet. Layoffs are not happening rapidly.
No.
And the job market pretty strong there. So on the upside, we still have twice the number of job openings as unemployed people. So employers are not going to be so quick to lay people off. That is what is causing the Fed to have a bit of an issue right now. They're seeing really high inflation and all this stuff, and some indicators coming down, slowing down significantly. But on the other hand, job market is just rock solid for now.
Yep.
And that is definitely giving some uncertainty, I think, as to the direction of the economy.
All right. I'm going to do a dad joke of the week.
You should.
Before I do, I'm drinking a Snapple. Watermelon lemonade, by the way, which is really
Did they go to all plastic bottles?
I don't know, but it is.
I like the glass. Call me old-fashioned.
Nice. Recycle it. You can recycle this too, I guess.
Call me old-fashioned, Josh.
I will call you old-fashioned. But, little tidbit there in the cap, tennis was originally played with bare hands.
Whoa.
Who knew?
Isn't that called handball?
Yes. That's not a dad joke.
That's just a fun fact.
All right. Austin?
Yes.
What is the difference between a sock and a camera?
There's a lot of differences. I'm not even going to try.
One difference. One takes 5 toes and the other takes photos.
5 toes and photos. Yes. Very nice, Josh. I appreciate that.
Dad joke.
You. So the rest of this episode, I'd like to have a discussion with you because we chat a lot, but only small bits of our conversations actually ended up, on recordings. So let's talk about our opinion on whether or not we should have a definite, easy to understand and calculate, rules-based official recession indicator rather than the NBER just going,
yes, maybe.
Yep, close enough. Recession. So should we? What's your opinion?
All right. I kind of have 2 mindsets here. I'm a rules-based person. Austin knows I like to follow rules. I like it when there are clearly defined rules.
Yep.
Then you know what you're doing is right or wrong.
Well, as our compliance officer, that's a very helpful.
It is what it is. So I like clear, defined indicator. Having said that, it's hard to clearly define the path of such a large economy because there are so many pieces to it.
Yeah.
So I think as what the average person thinks of a recession, things come to mind a very bleak outlook, a lot of problems, a lot of issues. So I think I'm okay with it being a little more open-ended because, the NBER, it's always backwards looking. Yeah. They got to wait at least those 6 months for that negative 2 quarters to kind of make that judgment. And then from there, they got to determine everything else. So I'm okay with it being open because I think you can use it because it does impact sentiment. It does impact how people respond, impacts the market when people hear that word recession. So I'm okay with it being a little looser so that they can say, you know what, like we are right now, maybe we're still looking.
Right.
That gives a little leeway, a little flexibility there. So I get it. I love rules. And I think this rule of thumb is a good way of saying, are we close to a recession? So that 2 negative quarters, I still look at it as that's a good indicator that there's something wrong. If you go 6 months of negative growth, maybe.
Right.
So I don't think from a general standpoint, you should go away from that being your kind of starting point or like the general rule of thumb. But I'm okay with them having some leeway.
Gotcha.
You?
Yeah. I like taking the emotion out of it and just saying, hey, these 4 boxes are checked, we're in a recession or we're not. I think it seems more like an art than a science the way it's done right now.
Yeah.
Which I think is a challenge. That being said, I acknowledge and recognize that every recession is different. And that, I think, is part of the issue with why it's done the way it is.
Yep.
Because in this, say we're headed into or we're in or whatever, a recession, we've never been through this economic scenario before. But I think if it were up to me as a non-professional economist, if we could get some sort of agreement on a bucket of indicators that are all-encompassing and we could do sort of an attribution analysis of every single period in time or whatever so that you could, look back and say, oh, well, it was consumer spending that made us into the biggest contributor to our recession this time, or this time it was fiscal policy, or this time it was ever. Like a lot of the GDP components you could probably do to do that and back into whether we are or not. I think a rule would help, but I don't like this soft, fluffy feel.
Let me ask you this question based on hearing that.
Yeah.
Was 2020 a recession?
I mean, yeah, I think that economic activity was on all fronts, except for fiscal, was just put to a complete standstill or negative for at least a short period of time.
Yeah.
So I would.
Did we get 2 negative GDP quarters?
We did Q1 and Q2.
Q1 and Q2.
Mm-hmm.
Yeah.
But it was really short.
Yeah. It was really short. It was a very short recession.
It was February to like April or May or something, right?
And I guess what I was wondering with that is obviously there was a large unemployment because things were shut down.
Yeah.
And that quickly recovered, thankfully. But, all those things pointed to it. But the NBER could have said that, this is not a recession because it's self-imposed.
Right.
Right? They could have made that argument that all these numbers are skewed because we purposely shut everything down.
Yeah.
And you probably could have made a really good argument for that. So I get what you're saying about having these check boxes. I think you need to better educate on a recession in general because people panic if they hear that recession. Right? That word. And maybe
we need to use longer
underlying
time frames.
Yeah.
Maybe this 6-month thinking, maybe you need to look at double it, go to a year.
Yeah.
And look at total year GDP rolling periods and try and take away some of the noise. I don't know.
Yeah.
It's tough. So, yeah, those are opinions on what the rules should be.
Defining
But
it.
the real question, Josh, that everyone's been sticking around for this is, are we in a recession in your opinion? Not the NBER, not the president, not the Fed chair. Josh Robb's opinion.
Nope, we're not. And I say no because, again, going back to, if that's how you're going to define it, then no, we're not in a recession.
Yeah.
Are we in a tough spot from inflation? Yes. Is the consumer feeling it? Yes. Are gas prices and food prices really hurting people's budgets? Yes. But if the recession is decided by the NBER and we haven't been decided a recession, then no, we're not in a recession.
Wow, you made it easy. You made it easy.
But that goes back to me, though, saying define it, because it almost sounds like you don't care when you say we're not in a recession right now because it makes it sound like all your pains don't matter. So that's why I think it needs to go back to better defining or indicating, well, who cares?
Yeah.
Recession is a term for a period of time. But let's say we flip-flop it. Let's say inflation's really low, but unemployment's really high.
Right.
Are we in a recession? Probably not.
Right.
Maybe if GDP is not negative.
Right.
But do you feel really, really upset about life? Yeah. So I think there's a difference between those two, which is why we see consumers at the lowest point of their feelings than we have in a long time.
Right.
Because the things that are bad are impacting the average person's budgets more than if we would have had other pieces of the indicators of recession creeping up.
And I'm glad you said what you said because you said the average person. And I think that brings us to another point is that whether or not we are in a recession is different for everyone. Macroeconomic landscape impacts people on the lower end of income spectrum a lot more than it does on the higher end of income spectrum. So if you're making a lot of money and doing very well, your spending, while you certainly are seeing inflation as well, you aren't really feeling it at all.
Yep.
But that is making a lot bigger impact to people who make less money. Whether or not we're in a recession or not is different for everyone. Yeah. So, and my opinion is that we're not in a recession, and I could really care less what the NBER says. I know what the NBER is going to cause some drama because people are going to say, hey, we're officially in a recession or not, 6 months late.
Yeah.
But I think that the employment situation is far too good at this point to say we're in a recession. And if you break down the components of GDP for the first and the second quarter, the consumer components were exceptionally strong. So that is numbers-wise why I think we're not. But, hey, we'll just have to wait to see what officials come out and say eventually.
It's the same as like a bear market, right? The official bear market is down 20%.
Closing basis.
Yep. But let's say you get to 19, like we did in, what was that, 2018? We didn't quite get there.
It was like 19.8.
Yeah, right?
Intraday,
and then 2011 was right there too. It feels just as bad just because technically you didn't call it that. It's to me, it's the same thing. It's like, okay, we weren't technically in a bear market as we're technically not in a recession now. But it doesn't feel good.
Your account value seems
it's
the same.
You're going to react the same.
Yeah.
And speaking of reacting, we should talk about what do you do?
That's the question. So this is where I'm going to come to you as my financial expert in my life, Josh, is what are some things you can do? Because whether or not we're in a recession, I think is irrelevant right now.
Yes.
But we're headed towards some sort of slowing of our economy in general because it's grown very quickly coming out of COVID.
Raising rates is designed to slow the
Exactly.
economy.
So our economy is slowing, but in my opinion, we're getting a recession at some point. So what can you do to financially prepare yourself for some sort of economic slowdown or recession?
All right. So we'll walk through a couple things. Again, the first one always comes back to make sure you're talking with your financial advisor.
Yeah.
Make sure you have a plan and that the plan accounts for these type of things. All right. What's the first thing you need to do? Well, if you know there is going to be a slowdown and there could be a disruption in your income, you need to know where your money's going.
Yep.
So make sure that you take a hard look at your budget. Make sure that you know exactly what are your required spending, which is, those have to happen every month. Mortgages, utilities, property tax, the things that you have to pay versus discretionary spending, which is, I could live without it.
Movie tickets
all the fun entertainment stuff, all the good stuff that's actually fun in your budget. but know how much you need minimum
Yep.
to get by versus all the extra fun stuff you'd like to do. Understanding that gives you a good handle on where you're at for your own comfort level.
Yeah.
Your job is important. So like right now we're talking about whether we're in a recession or not, the job market at this point has not been drastically affected by where we're at. And so job security is still pretty strong. I mean, there's not a lot of layoffs right now. But understand where you're at, what your industry looks like, how easy it is for me to find a new job based on my skill set and my experience.
Or how frequent it is, I guess, that your industry does layoffs when things slow down.
Yeah. Am I one that right away we're one of the first group to go? So understand that. Be ready to go if you need to. Maybe have some backup. Get some side hustles going just in case, those type of things.
Update your resume.
Yes.
Yeah.
Always have that ready to go. I don't know. Cover letter.
Do people use cover letters? I don't know. Sure.
And then, if you're worried about a disruption, having excess cash is never a bad thing. So we always call that emergency fund. Maybe you beef that up a little bit. Maybe you're sitting there at about 3 months of your living expenses. Maybe you push it up to 6 just to have a little extra cushion in there. Again, it comes back to where are you at in your own industry? Let's say you are a nurse and there's always opportunities for nurses. You may have to travel a little farther, go to a different spot, but there's usually a spot where you can have. Then there's less worry about that loss of income disruption. But if I'm in an industry, like you said, where like construction, where if things slow down, people aren't building new, I may go and be laid off for a little while. Okay, I need to be more aware of that. There's different industries that react differently to that.
Absolutely. That leads us to our next question is what about your portfolio? Because obviously the majority of people, not just in the US, but around the world, their financial assets, stocks, bonds, mutual funds, whatever you're holding, likely down this year.
Yes.
So that's where the markets are right now. We know that over longer terms, things recover, and we're not concerned about that. And we've talked about that many times. But Josh, what do you do if you're at different stages in life with this situation right now?
Yeah.
Because the markets and the economy are separate. However, they do tend to follow some trends.
Yes. So when we're looking at the overall portfolio, this advice goes true to everybody, is go back to your plan, no matter how old you are or where you're at in your life, and stick to that as the overall strategy. But within it, let's say you're a younger person, downturns are great. You shouldn't be rooting for recessions, but
you're buying
you should be glad
sale.
when you have the opportunity to continue to add money into your accounts when the market is down. Because everything that you are buying is now at a lower price, so you're getting more of those shares for the same dollars you're putting in. So these disruptions for young people, great. Just keep adding your money. Don't give up. Don't change that. If you're older in retirement or living off your portfolio, it's a little harder. And that's where having the plan comes in place. But thinking through, okay, do I have assets that are less volatile that I can live off of while the more volatile assets recover? Having an allocation that's diversified to give you some opportunities there. For everybody thinking through this, they might create kind of one-off opportunities. So one of the things we talk about is Roth conversions, moving money from IRAs to Roth IRAs. Well, when you do, you create tax. So if I had, let's say, a $10,000 IRA, and now because the market, it's down to $6,000, right? I'm down, that's pretty steep, but $4,000, 40%.
You were in ARC.
Yeah. So, but let's say I'm down. I could move that money from a traditional IRA to a Roth IRA. I'll pay tax on that $6,000 of income, 6, because that's what the value is when I moved it. But if I move those same investments and they have the ability to recover, I'm only paying tax on $6,000, not $10,000.
Exactly.
So there's some opportunities where if you look at it from a bigger picture to say, hey, if I'm down in value, is there anything I can do with this money while it's reduced in value that I wouldn't have wanted to do when it was a higher value?
And Josh, what is another great example of that?
So that's an IRA account. So if you have a taxable account, is if it's down in value, and let's say it's even at a loss, I bought something for $100 a share, now it's $80 a share, I'm down. And if I were to sell it now, I would actually realize a loss. I lost money. Well, we always say, stick your plan. You're not selling because you're panicking, but you can say, you know what? If I have things that are gains, I could offset that tax by selling this thing and then buying something different. It has to be different. It can't be the same thing again. There's a whole rule. Wash sale rules. But that's called tax loss harvesting. I'm harvesting, taking my losses, and then I'm going to utilize those on my taxes, but then I'm going to take that money and reinvest it right away into something maybe similar but different, so that I'm back in the market to capture the recovery, but I'm going to grab those losses while they're there and I'm going to use them.
Right.
So there's some opportunities for both of those. There's also opportunities that if you are looking to exit a position, it's cheaper now than it would have been if you had high gains. Let's say you're not at a loss, but you're just less capital gains. If you really wanted out of that position, you're going to take less of a tax hit now, especially if you plan on reinvesting that money somewhere else. You're still going to capture the upside potential of the market.
As long as you're in the market.
As long as you get back in the market. So there's some opportunities there. Again, it all comes down to planning, and you need an advisor to help you through that, to make sure you're doing the right things, because you'd hate to do a move like that and realize there's other consequences you didn't plan on.
Absolutely. Well, thank you for being here this week. That is our thoughts on whether or not we're in a recession, because it depends on who you ask. It is the question of the month, but we are happy that you were with us. So thank you for listening. As a reminder, we would love it also if you follow us on social media.
Oh, yeah.
Because we have Instagram, Facebook, Twitter. We do it all.
We're all over.
We're all over the place. And we'd love it if you'd share this episode. If you had someone asking, hey, am I in a recession? Is this a recession? What's going on right now? Share this episode with them, and they may be as confused as we are at the end of it, because we don't really know. And we would also love it if you would email any ideas or topic thoughts or questions to hello@theinvesteddads.com. And hey, who knows? Maybe your idea turns into an episode one day. We'd love to hear from you.
All right, sounds good.
Well, until next Thursday, have a great week.
All right, talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.